So if you've ever read the book from R. Nelson Nash, Becoming Your Own Banker, there's a part in that book that talks about equipment financing. And it talks about how you can use your own banking system, the infinite banking concept, to finance your business's equipment. So think about how relevant that is in today's world. How many businesses need equipment? I mean, there's landscapers, they're constantly buying new equipment. There's all sorts of construction companies out there, they need lots of equipment. Painting companies, everything in the development and the construction world, contracting period, needs equipment. Matter of fact, their CPAs a lot of times tell them to run out and buy new equipment before the year's over so they can get the tax deductions on that. But who's winning in the equipment financing game? It isn't the business owner, because the business owner's constantly writing checks to somebody else's bank. But R. Nelson Nash in there showed how to reverse that and how to take back the banking functions in your life. And I want to show you the new version that we just came up with that basically shows the same idea of what R. Nelson Nash came up with many, many moons ago. And we redid it. And we're going to show you how your company can get all the money back for every single piece of equipment it ever buys, uses, and owns. And we're going to do this with a real example of a junk removal business. Check it out. So in this video, Craig and I are going to dissect how this works, and we're going to show you the mathematics of why you and your business want to be their own bank. Because getting your money back for everything you buy is a pretty sweet thing.
What I'm going to show you in this case study, you wouldn't be able to put that extra money into premium. So what could you do? You could put it in your segregated account. You could use that for premium next year. But what we're going to show is the case study that Nelson Nash originally put together, where you capitalize for a while and then you don't put any more premium in and you use the overpayment of loans to pay your premiums. So I know that's a lot, but we're going to go through it step by step. And so let's just go ahead and jump into it. Who here loves the junk removal business? I think it's such a cool business where, you know, these guys drive around these trucks, whether it's construction jobs, whether it's the person that wants to clean out their garage, whether it's someone that has a mattress, you know, it's all those cool things. And I've actually got a client that I'm working with that is in the junk removal business. He's got a infinite banking policy, and he plans to capitalize that and eventually buy more trucks. And so I've spent a good amount of time with him, just kind of understanding his business, how it works for him. Think of it this way, for anybody that's a business owner, in this case, we're using the junk removal truck. They have certain amounts of fees that they can charge based on a truckload. So if somebody has a big job, it's a full load of a truck, it's going to be $625 for the load of that truck. They may go out on calls where somebody's got a garage to clean out, maybe that's a half a load, and then they're going to swing by, pick up a mattress. But guess what happens? When you have one truck, you're kind of capped on your revenue. So here he is thinking, if I can get more trucks, not only that, but I can expand my cities that I work in, I'm going to create more revenue. And this particular person I'm working with, his name's Brandon. He's in North Denver. He's got a company called Altitude Hauling. And so they do a lot of junk removal. They have dumpsters. They have all sorts of different ways of doing junk pickup. But in sharing his story with me, he said, you know, I want to expand to different cities. So along the Front Range of Colorado, for those of you that are in Colorado, you know, it kind of extends from Fort Collins on the north all the way down Colorado Springs or Pueblo. There's a lot of people that live in that range of the Front Range, and he's only in a section of that. But if he can start expanding, guess what his revenue is going to do? Go up. So just to put some context behind it, he says they try to do 5 jobs a day and they average around 300 to 350 per job. And so for one truck, he can get about 300 to 500 gross revenue per truck. So wouldn't it make sense for him to get more trucks? So that's kind of his story. Wants to continue to expand and grow. So kind of sharing the strategy with him as well. All right, so let's move on. So just reiterating, guess what? Now, when I talked to my friend Brandon about his business, The trucks that he's buying are close to about 90 to 100,000. So just think if I build a system for 90 to 100,000 per truck, I need to put a little bit more in it. What I'm doing is going to show you a use case where we're building financing for trucks around 52,000, but the concepts and everything else continue to remain the same. Now, let's look at the cost of equipment financing. So if I'm going to finance one truck, we've already looked at this. It's going to, net cost me about 62,410 because there's 900 or 9,810 of interest. We're going to make $1,300 payments for 4 years on that truck. Now, what if I want to expand my business and buy 2 trucks at a time? Well, then I'm going to be putting $2,600 of payments into the system, and 124,820 would be the financing cost. So we're just kind of looking at what is the cost of financing, whether I'm using my own system or or a third party. So if I go to the bank and I want to buy 3 trucks at once, $187,000 walked out of my economy. So we'll come back and revisit some of these numbers. Now, what we're doing in this model is the junk truck owner, let's say he's 30 years old, and really you can insert maybe 40 years. Well, the use case will change, but in this case, he's 30 years old. He plans to keep this business for 30 years. So he's going to look at a couple different situations. What if he bought a total of 8 trucks over that 30 years? He would spend $499,000 in financing. And so if he's using third-party financing, all of that left him. It left his family. It left his business. $500,000 gone. He will have 8 trucks over that time. Now, if he does 16 trucks, and if you're taking notes, maybe just jot these numbers down because you're going to be seeing these again over and over. 8 trucks, $500,000. 16 trucks, about $1 million. 24 trucks, which would be buying 3 trucks at a time every 4 years. That's going to cost him about $1.5 million. Okay, so wouldn't it be great if we could capture or keep a lot of that money in your company or your own system? That's what we're going to cover now. So for anyone that's been around our campfire, worked with our group, Chris has done some policy design videos. We like to put names to different things. And so, for example, we've got the Nelson Nash special. Nelson Nash was big on the 60-40. And the reason he designed his policies that way is to allow enough base to continue with the financing over time. So in his equipment financing model, what he did is he capitalized with $40,000 a year for 4 years. And what that means is he would put in $40,000 in year 1, $40,000 in year 2, 3, and 4, and then he quit funding the policy. He would use dividends and any surrendered cash value to pay the base and then start using that as a financing system. So in our examples today, I'm calling that the Nelson Nash special. That's the capitalized for $40,000 for 4 years, 60-40 policy design. Now, you may have heard of the concept of a dump-in. A dump-in is basically just taking a big chunk of cash and dropping it into the policy. And you're going to do that from the start. So you're doing an immediate capitalization. And so I know that a lot of people in our campfire or our community, they do dump-ins. We've all done some dump-ins. And what would that look like if we were building a financing model and we capitalized right away? So I'm going to show you a design where if you capitalize with 120,000 dump and then do 40,000 of premium for the first year and then put nothing else in it, use it as a financing. Then we're going to go over another policy design we call the Beast. The Beast is a split of a 75% paid up additions, 25% to the base, but yet we're going to go back and do capitalization of 40,000 for 4 years. Okay. And then I came up with this thing called the caffeinated Beast. It's taking the 75-25 and adding a dump into it. So we're really just going to juice the Beast policy, put that dump in there, and just start building financing right away. So that's what we have. The Nelson Nash special, the half Nelson. Any wrestlers out there? Anybody do wrestling, whether in high school, college, or maybe as an adult, you wrestle too, who knows? But yeah, we got Devin was a wrestler, so you know what the half Nelson is. We got the Beast and then the caffeinated Beast. Oh, we got some WWFers out there. Awesome. All right, so here we go. Let's talk about the Nelson Nash special. All right, get your thinking caps on because we're going to be going through a lot of numbers here. What does it look like to capitalize a policy. And when we talk about capitalizing in this manner is you're funding the policy, you're funding your bank for a period of time, and you're not using the money while you're capitalizing. That's what this whole use case was about. So what Nelson Nash had is he would put in 40,000 for 4 years, and you'll see here deposits to your bank. That's the 40,000 going in. We're not taking any loans, and I'm just kind of watching what's the dividend growth over time. Now let's go back and do a little quick math here. So the 40,000 is the premium, and Nelson Nash did what was called a 60-40. So he's taking 60% of that 40,000 goes to PUA, and 40,000 is going to the base, or I'm sorry, 40% is going to the base. So about 15 to 16,000 is of the base. Now, what is the minimum that's required for the policy? And I see someone asking, what is a PUA? And we probably should have touched on that earlier. Paid up additions. So when you look at a traditionally designed life insurance policy, if you put in $40,000 into a traditional life insurance policy, 100% of that 40,000 is going into what's called the base, which buys a lot of death benefit. It has no cash value for the first 2 to 3 years. And this is why you'll hear the Sue Zormans, the Dave Ramseys. As a matter of fact, I just watched a video yesterday. Dave Ramsey was saying, if you hear from a whole life agent, get your stick out and beat them, and they just don't get it. But what they're talking about is if you put money into a traditionally designed life insurance policy where 100% of your premiums are going to base, you won't have cash value for at least 2, 3, maybe in 4 years. And even at that, it's pennies on the dollar. So what we're doing, and everyone's hitting on this, the rocket boosters are the PUAs. We put money into these PUAs that create high cash value early in the policy. It lowers the death benefit, it lowers the commissions on the policy. So it does a lot of things, but it's designed and benefits you as the policy owner. So thanks, Jared, Michelle, for calling out the rocket booster. That's what we call them. So in this case, the minimum that needs to be put in year 5 and beyond would be the base of the policy. So it's about 15 to 16,000 is what's required to be put in. Now, what Nelson Nash was doing is he was simply saying, I'm going to let the dividend. So you see in year 5, the dividend is 10,198. That's going to be used to cover part of that 15,000 base or that 16,000 base. The rest of it's going to come from surrendered cash value. And this is just the way he built it. Dividends are paying the premium and any cash value that, above and beyond that dividend that's needed to make up that 15 to 16,000. So what I want you to understand and make sure that you're seeing clearly is you're not putting anything else in this policy. The policy is paying for itself. However, we're going to be doing that through financing. One other thing that I added here is this 120. This is just the minimum amount of paid up additions that needs to go into the policy to keep that open. So just to be clear on how these work, I did put that 120. So at a minimum, think of this 120 as a cost of your own financing system. So you're paying your own bank $120 just to keep your account open and healthy. Okay. All right. So we're going to continue on. There's nothing going on in this policy other than capitalizing it and putting it on what I call autopilot, where the dividends and any surrendered cash value. So you see the cash value over here is 144,000. If we need to take a little bit of that plus the dividend to make up the 15 to 16,000 base, that's where it's coming from. Okay. Now I'm going to look down at year 66. And if you're taking notes, just write these numbers down. I'm going to come back and review some of these again anyway. But what happened in this policy is it was capitalized and just never used for financing. It was never, more money never really came into it. So what I want to show is just if you set this up and walked away, you put 163,000 into the policy, and at the end of year 66, you've got $398,000, a death benefit of $622,000. And a dividend of $18,185. This is what it looks like if you just fund it and walk away. So this is kind of a stick in the ground of what we're going to be comparing against. All right. So using the Nelson Nash special, what would the system look like if we financed one truck every 4 years until he was at age 66? All right. So I'm going to go back and kind of run through these numbers. So here we are. financing for 4 years at $40,000. That was our capitalization phase. Now at year 5, what's happening here? We took a $37,000 loan, but you're saying, but wait, Craig, didn't you just tell me that the cost of the truck was $52,600? That's correct. It's just the shorthand way of the way the insurance company presents this is if you paid $15,600 towards the loan in that year, net your loan taken was $37,000. So the 37 and the 15.6 is the 52,600, the cost of the truck. Where are we coming up with the 15,600? Can anyone remind me or recall where did this 15,600 come from? Remember how we financed the trucks? The cost of financing? There you go, Troy. The monthly payment is $1,300. So every month we're putting $1,300 into the loan payment. So for the year, it was 15,600. So awesome job. Now, we have a loan interest that is accumulated of 1,850. So our total loan balance for that year is 38,850. Next year, we're going to put in a total of $15,600 towards the loan. We're going to knock our loan balance down to 24,413. The next year, we're just going to continue that until, look what happens when we get to year 4. So we bought the truck at year 5. We financed it. We paid the loan in year 5, 6, 7. What's going to happen in year 8? We only have $9,253 left on our loan, but we are honest bankers. So we are going to pay the $15,600 back into our system. This is part of the magic of the whole setup is I have $9,253 left in the loan. Look what happened. I put $6,347 into the premium of the policy, which helps create more cash value, which creates more death benefit, which, essentially increases the dividend. So do you see what happened there? We took the overpayment of the loan and we put it into the premium. That's pretty cool. So we've designed the policy to the point where it has some room to do that. And we're just going to continue this motion. We paid off the first truck. Now in year 9, we're going to go buy another truck. So we have one truck, and maybe that truck's getting us about $300,000 to $500,000 revenue. We made some money, so now we're going to go buy another truck, expand to cities, and we're going to make another $300,000 to $500,000 with that truck. So we're just going to keep doing that year over year until we get to year 66. So what does it look like when we get to year 60 or age 66? For those of you that wrote this down, on my next slide, I'm going to show the numbers anyway. We did put a little bit more money into the system because when we capitalized, we had about 164,000, somewhere in that ballpark, that we put into the system. Our cash value of just capitalizing and not doing anything, we had around 398. So do you see what happened here? Let's look at this. So we capitalized 40,000 for 4 years on a 60/40 design. If I went to the bank of somebody else and financed this truck, or financed one truck for every 4 years for those 30 years, $499,000 is gone. It's out of my environment, right? I don't have any of that money left. It went to someone else's bank. So I bought 8 trucks. If I used my own financing, I spent $213,656 of deposits. So that was the initial 40,000 capitalization per year. That was the amount of overpayment that I put in. So I put in 213,000 into the banking system. My cash value was 500,000. So that means I gained, between what I put in and what my cash value is worth, I have a net gain of about $286,000. Now, I'm going to have a dividend that is generated off of the value of that policy of about $20,000 a year. My death benefit is now $768. So let me ask you, here's another question for the group. Who would rather spend 500,000? So would you rather spend 500,000, that's a loss, or finance your own system and have $286,000 in your pocket? So who likes buying trucks or cars or copy machines or anything else used in your business? Who wants to do it through your own bank versus someone else's bank? Money in the pocket, please. Yep, absolutely. So here's another fun aspect of looking at it this way. So our junk guy, let's say he gets to age 66 and he wants to retire. He sells the business. Okay. So he's going to sell the business to somebody else. Let's say Stephen Nagy, wants to buy this junk business. So Stephen Nagy buys the business. Well, the guy that owned the business could continue to finance trucks for Stephen. So couldn't he generate an income off of financing trucks for Stephen, who bought his junk business? So I put a retirement income down here, and it's a range, because if I wanted to be really conservative, I could just live off of that dividend. So see, the dividend is $20,000 a year or somewhere in that ballpark. Or I could take this 500,000, and some of the people you'll hear from during the 3-day would be talking about private lending. There's a lot of different investment opportunities out there. But let's say you took some of that 500,000 and you put it to work at 12%. That could generate you close to $60,000 a year. And so when we look at this whole picture, you not only have money in your pocket, but now you've got a retirement income machine simply by financing your own business assets. That's pretty cool. Now, the question would be, if it works really, really well for buying one truck every 4 years, what if I bought 2 trucks every year? So let's go look at that. So if we buy 2 trucks every year, we buy 2 trucks every 4 years for the next 30 years, what does that look like? So here we are with a Nelson Nash special again, and we're going to go through and capitalize for 4 years. We now have a net loan of $74,000 because we're actually, our financing is about $105,000. And one of the things we have to look at too is this cash value at the end of year 4 is $141,000. So could I finance 10 trucks with this policy? No, I don't have enough capitalization. So I always need to be looking at, have I right-sized my banking system for the amount of financing I need? And so when we look at 141,000, yeah, I've got plenty of room to finance 2 trucks. I can get 105,000 out of this because I have 141 of cash value. So that's something we're going to be gauging as well, as how much capital do I have? How much financing do I need? That's going to be part of the policy design that we will be doing to help you with in terms of setting up your system. So now here I am, 74,000 as a loan. We're going to go through the same motion, but now instead of paying 15,600, we've doubled our payments. So now every year we're paying 31,200 in loan payments back to our system. So just like the first time, we have, instead of 9,000 left over, we now have 18,000 left over. So by the time I pay that 31,200, I only need 18,000 to finish off paying off the loan to the policy. That means I can put in 12,694 of premium back into my system. So you'll see that as we add more and more trucks, we have the ability to add more and more cash back into the deposits of our own banking system. So there's 2 different streams. There's some money going into the policy loan. And remember, when we pay our loans back, our cash value is going to be going up because we're increasing the amount of, we're actually paying that loan back, which is increasing the available cash value. The insurance company is keeping a little bit of interest. So this little bit of interest is what they're keeping. But we're just going to continue on in this motion. The next 4 years do the same thing. So let's go down and look at year 60 when we're age 66. Who can recall how much cash value we had when we financed one truck every 4 years? Who can put that in the chat? We had 500 exactly. So we haven't really done anything differently than just decide to use our own system and finance our own trucks. Now that we're doing 2 trucks every 4 years, we've increased our cash value over $100,000 just by financing our own trucks. We've now injected about 264,000. Our death benefit's almost $1 million now. And we have a dividend of 23,000. Okay. So you'll see as we continue in these use cases, the more we finance with our own system as opposed to giving it away, we just keep increasing our bottom line. All right, so we got a few questions in here. And Chris and Stephen, I imagine you guys are keeping a close eye on the questions. Anything we need to stop and address at this point?
Yeah, one of the things I think that would be worth talking about is there's a lot of messages and I'm answering them, but it'd just be good to hear from you. What we're dealing with here, we're dealing with COLI policies, company owned, which means the premiums are paid by the company, the loans are made within the company to buy equipment for the company. So a balance sheet item would be an asset, and then the payments for the payments back to the policy. So it's all within the company. Therefore, it's not like how we teach sometimes, Craig, where I own the policy individually. I lend it to my company at a higher interest rate. My company then pays me back with interest. That's a taxable event to me. But here, can you just hit a little bit of and we're not giving tax advice. We're just explaining COLI versus individual. Just talk a little bit about that.
Yeah, and it's an interesting concept because when you read Nelson Nash's equipment financing model, he stresses keeping the policy on the personal side and loaning money to the business because he's kind of laying out that retirement strategy too. So whether you own the policy on the personal side and loan money to the business, there's some tax considerations, and that's where you'd want to have a conversation with your CPA. The alternative is the business owns the policy. It could still be on your life. And in corporate owned policies, there's different ways of structuring those key man, so there's different ways of structuring that. But ultimately, the business owns and pays for the policy. So all the money stays in the business. And so it reduces some of those tax consequences. So if the business is making those payments to the policy, as opposed to paying you personally and then you pay the loans back, there are some differences in the tax consequences. So Chris, anything you want to add on that one?
No, I think that's good. And then Stephen, you had a great question. Like he talked a little bit about something earlier. Should we hit that later or do you want to bring that up now? The text we were going back and forth about?
Yeah. We can do some Q&A. I mean, I can hit on that. It's, basically just wanted to kind of talk to Craig a little bit more. So it's not relating to this, more talking about Craig and his story and kind of what led him to IBC and, starting with his daughter's college and how that's morphed into more of an and thing as opposed to, just the one use case.
And then Craig, one other thing that came in that I think is, and we'll get to that in just a second, that I just want to hit before I forget. Somebody was asking, would this work with a 90-10? Would it mech because we're adding in too much? And then there seems to be a little bit of confusion in regards to PWAs and like being increased as you buy more trucks and add them back into the system to keep you from meching. So like the meching side of it. So they're just like a combination of a few different questions. Sorry, I'm throwing a lot at you.
Oh, no. I mean, it's really good stuff to understand because just like on the 90-10 question, can you do a 90-10? You have to remember when you do 90-10s, you're squishing the base portion of the policy down quite a bit. And what that does is in the future, you just can't get as much money into the policy. So why did Nelson Nash stick with the 60-40? Because it kept the base large enough where you had enough room to continue to put money in when the policy was efficient and continue to do that financing. So, and I'm actually going to show you what happens when you start doing 75-25s and dumps. We do run out of room. You can run out of room. And so we have to be aware of that. Now, if you do a 60-40, you're going to give up a little bit of cash value at the beginning, but this is a long-term game, and we're looking at the benefits of doing it long-term. So can we do it with a higher split? We can. We just have to be a little more careful with the design and understanding how much money you want to put into the policy. So when I get into the dump ins, you'll see that we ran out of room. And so we'll talk about that. As far as there's a question about my story. So my first policy I started was about 15 years ago. And I was searching. I didn't know what I was looking for. I just knew that the path I was on, the traditional 401k stock market, that it just wasn't for me. I'd seen enough train wrecks, enough people that just didn't have success with that. So I was searching for what else is out there. And I actually went to a college planning. I have 3 daughters. So I was kind of figuring out how in the world am I going to pay for college. I went to a college planning session, and this guy's up there talking about infinite banking, but he didn't really call it infinite banking. And at the end of the seminar, I went from like, how do I learn about this? Sounds really neat. I don't know what this thing is, but what is it? And he said, well, you can read a stack of books. He puts his lower hand and his top hand about 3 feet apart. And he goes, you can read a stack of books this big, or you can come and talk to me. And I said, well, what are the books? So not to say I don't want to talk to him, but I really wanted to hear and see for myself, what was this? So I did a lot of reading. Nelson Nash is Becoming Your Own Banker, just learning a lot about how money works, the stock market, and all these things. And, eventually started my first policy. And, fast forward, I'm using a lot of my cash value for private lending, equipment flipping, and those types of things. So just kind of financing my own, my own investing strategies. We did some house projects, redid the stairs. We took the money out of the policy. So we're planning to do a kitchen remodel, and I'm always looking for who's going to pay for that, because I'm not going to pay for it. I'm going to use private lending, run it through my policy, and someone else will pay for it. So those are some of the things that I'm doing on a practical use case with my policies.
Yeah, it's really cool how, there's probably a lot of people out here that feel this way, but how you started with one kind of goal in mind, you're using your policy, and then, 14 years later, now you're using it for all these other things. And it's just nice, as opposed to like an IUL where it's all hypothetical what's going to happen. With this, it's guaranteed. We know exactly kind of what that's going to look like, so we can start thinking about the future, even if we're not thinking about the future today, and knowing that it will be there for all that and stuff later on. And I mean, that's one of the things that I really like. I don't know if anybody else can relate that way, but.
Yeah, I mean, absolutely. And one of the things we do with folks that have third-party debts, credit cards, car loans, we run them through the debt blaster, and guess what? At the end of that debt pay down cycle, you'll have cash value. What do you do with it? Well, that's when you move into the next phase of building wealth, whether that's private lending or, investing in your own business or whatever it might be. So it's just really awesome, the different paths you can take with this, and it can morph into completely different in 10 years. So we'll go ahead and continue on. Let me know, Chris and Stephen, if there's anything else that pops up. But for every policy design that I'm going through, you'll kind of see this summary. And so what you're going to continue to see is the more trucks we finance, we're putting a little bit more money into the system, but we start to see this effect of more and more cash value. Now our gains are bigger. This 998,000, that's how much money would have left us versus having 340 in our pocket. And it just blows me away when you start to see these numbers. All we're doing, folks, is we're simply changing, like Chris said at the beginning, we're just changing where our money goes first so that we can start to finance our own stuff, whether this is cars on the personal side, whether this is real estate. This truck could be swapped out for whatever your thing is. We're just happening to use this junk removal because it's such a cool business. So now with doing the 2 trucks every 4 years, we've increased our cash value another 100,000. We've increased our retirement income up to the 70,000 every year. Our death benefits now 917,000. So it just keeps getting better and better. Now the question is going to be, if I can finance 1 truck and then I can finance 2 trucks, can I finance 3 trucks? So yes, we're going to just keep doing the same thing over and over. Now, this 19,041, There's room in this policy, so we're going to add the full amount of that 46,800 minus the remaining loan. The rest of that's going into our deposits in our bank, just like in example 1 and 2. So I'm just going to jump down. Look what happened. By now financing another truck, we increased our cash value another 100,000. Our gains now 390. So here again, instead of losing 1.4 million, I've got dang near 400,000 in my pocket, and my retirement income is now bumped up to about 84,000. So it's just a thing of beauty. Mark, you nailed it. The system's infinite. It just keeps getting better and better and better and better. So it's really a thing of beauty. Now, for those out there that maybe you have a policy where you did a dump in, or maybe you're thinking of doing a policy where you have a dump in, will this work? Can you do a dump in year 1 and then start financing? Well, let's take a look at it. So here we are, just to set the table, 160 is going into the policy. So I'm just going to take one step back here. 160 is cut into 120,000 going in as a dump and 40,000 going in as premium. Now we're still keeping that 40,000 as a 60-40 split. So 60% of that 40,000 is going into our paid up additions, or our rocket boosters, the thing that creates that high early cash. 40% is that base that is kind of, just think of the base as the bare minimum of what you need to put in to keep the policy healthy and happy. Okay. 160 is going in year 1, and then we don't put anything else in. So here we're just simply looking at, what does the policy look like if I just fund it and then walk away? Well, let's go look at years at age 66. If you recall, and I don't want to have to jump all the way back, but if you recall, I asked you to kind of jot down a number. When we capitalized the Nelson Nash special, we had about 398,000 of cash value, if you recall. So by doing the dump in, we actually have a little bit less cash value here. This opens up a big discussion of, well, why? And why is our dividend a little bit less? When you do a dump in, our friends at the IRS, whether you want to consider me your friends or not, they have a set of rules called the modified endowment contract. And they specify that there has to be a certain amount of death benefit and a certain amount that has to work with your amount of cash that you're putting into the policy. So for example, I couldn't go just put 200,000 in a policy and then make a premium of 5,000. The IRS would say you're taking advantage of the system in a accelerated way. We're going to now tax your policy. The way we get around that is we add a term rider inside of the policy. And so why you're seeing this be a little bit less than the Nelson Nash special, so we have some term cost up front, and it created a little bit of drag for us. But if you're trying to capitalize right away, well, that's just the cost of doing business. But that's why this number is a little bit lower. So let's go ahead and look at, what would it look like if we financed a truck? So instead of waiting until year 5 to finance a truck, we're going to start right away, and we're going to finance our first truck at the end of year 2. And we're going to do the same thing. 52,600 is the cost of the truck. Our loan payment is going to be 15,600, and we're going to continue that. So this whole motion is pretty similar. We're putting in 6,347. That's the overpayment of the loan. So we're going to put that in every 4 years. And at the end of age 66, instead of having 500,000, we have 494. Instead of 768,000 of death benefit, we're at 760. So we have a little bit of less cash, but we're able to start earlier. We're able to get our system capitalized. So for those asking the question, can I capitalize right away and start using the system? I would give an answer of yes, you can. Is there a cost, a long-term cost? Yeah, I mean, we're off by about 6,000 in cash value here, but it's still better than losing 500,000. So whether you want to capitalize for 4 years or you want to do the dump in, it still works. I do the same thing, and a lot of this gets repetitive. Let's finance 2 trucks. And so if we look at the result, well, we bumped up to 614. So we're going to see the same thing over and over here, but what I want to do is jump down to the third. So can we finance 3 trucks every 4 years? Well, let's take a look. We can, but I want to draw your attention to this little alert flag here. We have too much financing with too little capital. So Nelson Nash talks about in the Becoming Your Own Banker, don't try to finance too many things with too little capital. And I've had some people ask me in the past, well, what does that mean? What in the world does that mean? So I'm going to go back into the sheet here. So you'll see in the first time we overpay our loan, we have the ability to put in the full $19,041. We have a term rider on this policy for 7 years to accommodate this big dump in. That's what allows me to get this 19,041 in. Look what happened when I get down to years 9, 13, and beyond. I can't put the full 19,041 in. I only have room to put in 18,731. Why is that? It's
Craig,
because
this is key, and I'm sorry, I didn't mean to interrupt you, but I got a lot of questions coming in on this one thing. So make sure you explain like the extra P-way and the segregated account, because a lot of people confuse the two, and they're like, well, won't that mech it? So I'm glad we're right here because I'm fielding questions on this.
Yes. So if you tried to put in the 19,041 in year 9, the policy would become a mech. You would overfund that policy to the point where the IRS says this is now a modified endowment contract. We're going to tax you on this. So you don't want to do that, but we still want to be the honest banker. So what are we going to do with that extra money? Let me just jot down here. So we're $310 short. We can't get that $310 extra into our PUAs. So where are we going to put it? This is where, if you have a segregated account, you don't want to just go use it. We want to be the honest banker. So we're going to set that aside in our segregated account or just a side account. And if you want, you can use it for premiums or finance or start another policy. Now the 310, we're actually right on that hairy edge of becoming a mech or not becoming a mech. So in this case, it's, we're not too far off. So what do you want to do with that 310? Set it aside at a segregated account, use it for premiums or other policies or what you want to do. It's your money that goes into your system. So we can't get it in the policy. It could be used for loan acceleration for next year or whatever it might be, but it's just money we can't get back into the deposits of our own policy. So I want to make sure everybody understands that because it's a really big step. We've now got a policy where we're trying to finance too many trucks with not enough capital. We don't have a policy big enough to handle it. And the reason is because we did that dump in versus capitalizing for 4 years. So this is one of the effects of trying to get things in sooner than later. We just ran out of room. So Chris, let me know if there's any questions that need to be expanded upon on that step, but it's a big one to understand.
Yeah, just one here, and it's kind of in line. Chad was asking, is the simple interest figured in on that spreadsheet? So the interest of the insurance company, which it is. I just want you to kind of hit on that because I think there's a lot of times people get confused because there's the compounding interest you're earning on the policy, the simple interest that's being charged on the loans from the policy, and then the interest the company's paying back on the loan, which is just a calculation that anyone can figure out. So can you just hit those again and just show where they are on the spreadsheet?
Sure, absolutely. So let's look here at year 21, or actually year 22. We took out another loan for the 3 trucks. That loan cost, the interest cost to the insurance company that year was $5,550. Okay. Now, the policy dividend grew 17,612. So in your own system, my question would be, are you okay getting $17,000 in dividends for using your own system if you had to pay $5,000 in interest? I'll do that trade any day long. And we haven't really touched on this the whole session, but I haven't intentionally minimized this, but this death benefit, if God forbid something happens to you during this whole equipment buying financing, your business or your family or however you have your estate structured is now going to receive this $729,000 of death benefit. What kind of account comes with a cool benefit like that? So just looking along the path here, you've got your loans, you've got your loan interest. That's the simple interest being charged by the insurance company. And what you're going to find is if you took 87,000 times 5%, it's not 5,550. This is lower because you've been making those $1,300 payments across the years. So this is less than 5%. Okay. So I'm going to move on. If there's any other questions, go ahead and put those in the QA, and Chris and Steven can highlight those for me, but we're going to motor on here. So when you hear that you run into this situation where you have too much financing with too little capital, this is exactly what it means. I just can't get all of my, being an honest banker, I can't get all my money back into my policy. So then it's going to go into a segregated account. It's going to stay in your system, but you're going to then use it for another purpose. Now, I'm going to kind of fly through these last couple because I want to show you. Now, the Beast, we're still going to capitalize for 40,000 for 4 years, but we're going to do a 75-25 split. So now we're putting more cash up early, less base. So is it possible that we're going to run out of room here because we have a smaller base? Potentially. Let's find out. So when we capitalize, here's something interesting. If you remember back to the Nelson Nash special, if we just capitalize that policy, we had 398,000 of cash value. But look what happened on the 75-25. We have quite a bit more capital. So what does that tell you? It means we can be more efficient with cash value with the 75-25, but there are some drawbacks, and we'll see that. We may run out of the ability to fully finance, but this is a pretty good chunk of change compared to just doing the Nelson Nash special. All right, so we do the same thing. I'm not going to be late. You guys have seen this over and over. We're going to finance one truck every 4 years. We're going to overpay, so that 6,467 is now what we're paying. So now we're able to put more in to the policy than we were with the 60-40 because we pay the loan off faster. We have a lower base. Okay, so the minimum has decreased. It used to be 16,000 and now it's what, 10,000. So we have less base to deal with here. So at the end of the financing, we're now 589 in cash value. And if you remember back to the very first Nelson Nash special, first truck, it was about 500,000. So we have almost 89,000 more of cash value doing the 75-25. So here we are, 500,000 in the hole or 374. I think we all know which one we want to have. So I'm gonna motor through here, and this is 2 trucks. I'm just gonna go down 2 trucks. We have 691, and if you remember back to the Nelson Nash special, I think it was around 600,000. So now we have 91,000 ahead. So far this 75-25 is looking pretty cool. I'm liking it. Who wants more cash value? Who wants more death benefit? Who wants higher dividends? Of course you do. So we just need to design that policy to fit what you're trying to do. All right, let's go look at the net result of 3 trucks. Guess what? We were able to fully finance 3 trucks every 4 years on the 75-25. We had enough cash value. We had enough capital to do the financing. I was a little nervous, but it actually worked. So if we go back and look at this, we're able to get the full amount of overflow into PUAs every year. That's pretty stinking cool. Can we design a 75-25 policy called the Beast to do equipment financing? Absolutely. We just need to make sure that how much financing you're trying to do is going to work with a 75-25. So for me, when I was working through all these numbers, I'm like, yes, it worked. Now, because I was really worried that we were going to run out of room for the PUAs. So let's look at the caffeinated beast. I'm just going to do a quick query here. So the caffeinated beast is the 75-25 with the 40,000. However, we're juicing it with that 120,000 dump in.
Okay, let me
Here,
say something. Like, first off, what an epic freaking name, the caffeinated beast. Like, hat, glasses, hat off to that one. That's such an epic thing. But I want to really preface, this is a really important thing for people to understand, because so many people see in videos and online 90-10, 90-10, 90-10. This will crush a 90-10. And not only that, it'll have more stability in the later years, allow you to capitalize your system in later years, much higher. But you could never make this work with a 90-10. So this is like the ultimate, that's probably why you called it the caffeinated beast. I can't even imagine giving my cat caffeine. Hell would break loose. But yeah, I'm sorry, I'm going long on that, but you get what I'm saying. Like, this would be one of the best ultimate designs. If you were dumping money into a plan, you would not be able to pull this off with a 90-10.
and Chris, to that point, I love that you brought that up, because we've done policy designs. We've got some clients that want to put in, say, $300,000 dump, and they want to minimize the ongoing premium. And so you can typically, at the biggest stretch we can typically find is about a 10-to-1 ratio, meaning the premium, take whatever premium, if it's $10,000 times 10, that's kind of the spread. So if you're doing 300,000, we're on a dump in, we're going to need about 30,000 in premium. Now, a lot of people say, well, gosh, I want a 75-25 or a 90-10 on that. You're not going to get it because there's just not enough base. We've done 50-50 policy designs, meaning 50% to PUA, 50% to base on those really high dump in, low premium policies. They are amazing policies. They have cash on cash in year 2 is sometimes 120, 130%. They are machines. So if you ever want to do a really, really high dump in and a low premium, a 50-50 is really a very sweet policy design. However, I did want to, on this policy design, why can I do a 75-25? The 120 to 40 ratio is still pretty decent, where we can get away with a high ratio 75-25. If this was 120 and a 10,000 or 12,000 policy, premium, 75-25 wouldn't work. Okay. Now I'm going to go back in the comments real quick, because Shane had mentioned, I asked the question, who thinks this is going to work? Shane thinks it's going to mech out, maybe on the 3 trucks. So let's take a look. Let's find out. I'm dying to know what's
Craig,
going to happen with this caffeine.
That's perfect. And I want to segue into Long's question over here in the Q&A, because this will be a good place where you can show it in this round. So Long said, I understand always utilizing my cash value and keeping it in motion. I'm just trying to wrap my mind around perpetually paying for the loan interest from the cash value. It seems backwards. I love this, the backward. I should have played the backward bicycle. It seems backwards. Help me get past this mental block. Very common thing people think, because it is backwards from what you're taught to do in your life, but it's actually, once you learn how to do this, everything that you've learned in your life is backwards, and this is actually the proper way.
So if I understand that question, he's asking, why would I want to continually pay loans and loan interest back to the insurance company?
Yeah, Long, if you want to elaborate on that. So he's having the same problem with it, or trying to get his mind wrapped around the same thing everybody does, is, we take loans from the policy and we repay the policy back with interest. And he's kind of just like, that seems backwards. I think that's basically what he's trying to say.
Yeah, and there's a lot of math we can get into, but the first thing I would say to that is, because a lot of people will say, why would I, even if I have a 0% credit card, why would I pay it off with a policy? How much money is left in your pocket if you pay that 0% card off? At the end of the day, you have nothing left. You've paid all the debts off, your money's gone. If you run it through a policy, and even if you have a 5% policy loan and you have money in your pocket, aren't you ahead? Yes, you are ahead. You have money in your pocket. So it always comes down to, if I'm financing, would I rather spend $1.4 million? That money is gone. I'll never see a penny of it again. Or if I'm paying interest to the insurance company and I'm growing in cash value and dividends, I still have $472,000 in my pocket. So really the decision you have to make is, do you want to continue financing everything you do with some third party, or would you rather use your own system? And yes, there's a little tiny sliver of cost of interest that goes to the insurance company, but it's minimal compared to what you're doing on this type of a system. So if I do the traditional thing that everybody else does, I've lost 1.4 million. If we do it the way we're teaching, retirement income, let's say anywhere from 20 to 94,000, depending on how you want to do that, a death benefit of 1.1 million. And just because you financed your own equipment, you have 472,000 positive.
Another thing too, I'll
And
point out real quick, Craig, on that, because you brought up, like, you've mentioned death benefit a few times, but this is a COLI, this is a company-owned policy. So in a lot of companies, there are partners or, you know, literally, like, if I died tomorrow, I hate to use myself as an example, my company would need money to replace me, and I would probably be a very expensive replacement. I'm not saying that to brag, but like, all CEOs, all owners of businesses are an expensive replacement. So that death benefit has serious value in any entity structure. It could be, you know, paying, you know, like, let's say one of the partners passed away, that death benefit pays back to the company and buys that partner's family out of the company. Like, that's incredibly valuable. That's a buy sell. So we're just showing you just the math of buying trucks and why it makes more sense to use the policies versus traditional, but don't discount that death benefit and its importance in a corporate situation. Just like an individual situation, it's important. Just this year, we've lost a couple really close clients to us. And I will tell you, like, you'll never understand what you do in this business until you actually hand a family member a death benefit. It changes the game, folks. Like, I know we're always like, oh, cash value and how much am I making and blah, blah, blah. But like, when things go bad and somebody dies, you understand that all this cash value stuff means absolutely nothing compared to the real reason, which is the death benefit. But getting back to that, like, just always think we're showing you corporate situations. So a corporate situation, there's always a massive need for a death benefit. I mean, look at any big CEO in any company. They are heavily insured because if they're gone, like, that company has to replace them with another CEO, and that's going to come with a high six-figure paycheck.
there's so many side benefits that are huge. I mean, what Chris just talked about is huge. We've just been talking about the benefit of financing a truck and keeping control and cash. And that's another thing we didn't really talk about. If you're financing your trucks with a third-party financing system, a bank, and your business has a hiccup, maybe a slow period, like the guy that I'm talking to here in Denver, he's like, yeah, I mean, my junk business gets a little slow in the wintertime. You know, if you live in Denver, you've got snow and ice and people aren't so concerned about getting rid of junk. What if you can't make your payment that month? If you don't make it to the bank, are they coming to get your truck? Absolutely, they're coming to get your truck. If you can't make your payment to your business, who cares?
Call me, I'll come get the truck.
Yeah, Chris will come and get your truck. So a lot of what we're teaching here is not only the benefit of having that money at the end of the cycle of buying something, but it's control. It just, there's the death benefit. There's all these benefits that come along with it. And I don't think we stress it enough, but just think about financing your own equipment, having that ability. I had a bad month in my business and I maybe I'm not going to pay the full 1,300. Maybe I pay 1,000 and I get caught up, you know, 2 months later when an invoice comes in. You know, we all have that challenge with cash flow coming in and out. So it's just the ultimate amount of flexibility you have here. So going back to the caffeinated beast, let's go prove this out. Let's find out, can I do 120,000 dump and a 40,000 a year, just capitalize once on a 75/25? So here we are. We're just simply funding the policy. The caffeinated beast is getting fed. We're not financing anything just yet. And I want to look at this number here. So if you remember way back to the Nelson Nash special, financing for 4 years at 40,000, I think we were at 398 in cash value. So our cash value is quite a bit higher doing the dump in as opposed to the trickling it in. But there's trade-offs and everything in life, and you'll soon find out what that is. All right, truck number 1. We're going to do the same thing. Start at the end of year 2. We're going to finance our first truck, put all the overpayments into PUAs. Or into the premiums. Okay, so we see that happening every year. At the end of this cycle, the Nelson Nash special had about 500,000. This one has 585. So I mean, we put in 214s. We didn't put in nearly as much. So this one actually looks pretty cool. We actually gained about 370,000, a death benefit of 871. So check mark number one, we were able to at least finance one truck with our 75/25 caffeinated beast policy. Who thinks we can do two? Let's do a quick query. Do we have any doubters out there that we cannot finance two trucks? Let's see it in the comments. Do you think I can get away with financing two trucks with this system? Jared thinks I can do two, but not three. Shane doesn't think so. All right, so we got a split crew here. Let's find out. Drum roll. Tess, thank you. All right, so here we are. We're going to start doing two trucks. So if you add the 12,694 to the 8,506, looks like we're able to get the full amount in. So yes, we can do two trucks with this system. We're able to get away with doing two trucks. The benefits are, so by doing two trucks, we're now at 700,000 of cash value. We got about 435 in the difference of what we put in versus our cash value. Death benefits creeped over, $1 million. So here's where we are. Third truck. Look what happens. Who can tell me, this is for those that are really been following the math, who can tell me how much we are short in putting into our PUAs? I couldn't get it all in. So you can see that I put in 19,041 and then I was down to 15,129. I'm financing, my payments are 46,800. Does anybody know how much I was not able to get back into the policy? 3912. So Troy's got a 3912. Jared thinks it's 12K. All right, so let's take a look at it. Here we are with the alert again. We have too much financing with too little capital, but look at these numbers, 756,000. I wasn't able to get it all in. I was only able to put in 288,000 in my system, but I still have 756. That's really good. That's the highest number that I've seen. But that comes along with the fact that I came up short. And Troy, kudos to you. You nailed it. 3912. So here's how we come up with 3912. Take the 46,800 minus the 27,759. That's how much excess I have to put into my policy, but I could only get in 15,129. So Troy is a math wizard, did it in his head. I need spreadsheets and calculators. So now what do we do with this 3912? Well, that's a conversation we had before. We could go put it into a segregated account. We could start another policy. We could do all sorts of different things. But we're not able to get that back into our banking system.
Craig, that's a big reason why, I ramped up so quick with my policies. When I first started doing this, I was paying debts off and my debts were high interest rates. And I built that segregated account up so much because I couldn't put the rest into the policy. And somebody was asking who tracks all that. We do. So through the mapping process and through the I team, we actually keep track of that. So every year when I was doing it with mine, I'd look at how much is in my segregated account, how much I'm putting into the policies. And then I would always ask, back then it was, somebody different than this in there now, but I would ask them, hey, can I put this money into the policy? And the answer was always no, because it wasn't enough room. So I would take the money from the segregated account, make sure that it was a stable amount per month, and I would set up another policy. And it's also largely why a lot of my policies are funded monthly, which I know a lot of people are like, why do you do them monthly? Because that's how the cash flow came in through the segregated account, because I was always recapturing money monthly. Therefore, I always wanted that money to go into the policy monthly to keep everything synonymous with how my banking worked. But I think that's an important thing is a lot of people, it's easier just to show one policy, and we're always just trying to stuff as much as we can into one policy. But folks, all of you, if you do even remotely a third of what we've showed you here, you're all going to have more than one policy. And it's not because you want more than one, it's because it's going to force you to, because you're going to want to always be expanding your capital that you can put through your banking system. It's why there's not just one branch of any bank you've ever seen. There's multiple branches, because that's how they expand their capital for their banking operations. And yours is no different.
Yeah, and I mean, it's often been said, if you don't have enough money, you have money problems. And if you have too much money, you have money problems. So in this situation, we have a money problem. Where are we going to put this 3912? And that could be the amount of money that you use for a new policy. If you start using this money to pay off your loan faster for the next round of financing, well, you're just going to have more at the end of that debt cycle. So this is a good problem to have. We just need to figure out at that point, where do you want to start stuffing your money? And that's where, it makes sense to get, a conversation with your money mentor. Should you start a policy now? What does it look like? How should it be designed? But all of this that we've covered today, I just really wanted to show what are the differences in policy designs? What are some of the benefits, the advantages? So if you're trying to finance 3 trucks every 4 years, this policy, may or may not be the thing you want to go with, but at the same time, it also had a crap load of cash value at the end of it, even though we couldn't get all the money in. So if you started looking at, well, I want to do a 90-10 or something like that, we're going to run out of runway way too fast. We're not going to have enough room in our policy to keep our financing system going. So then you'll start having a bunch of policies with 90-10s, and it just probably not the best way to go. So I wouldn't shy away from even thinking about large dumps where you do that 10-to-1 ratio and try to build a financing system off of that. So with all of that, I've got one thing left. Lots of numbers here. I really struggled on how to present this and come up with this, but I thought everybody would appreciate whether you take a screenshot of this and consume it later. This is set up to where you can see how many trucks were purchased for each policy, what the deposits are, how much did you inject into the system, what was the cash value at age 66, how much did you gain, what's the dividend death benefit. So if you just kind of look across the table here, when we look at the caffeinated beast, because we weren't able to get it all into the system, we were able to get 288,000 in. Most of these others, we were able to get 315, 316, 313. But I also look at the cash value here. The beast without the dump in was the clear winner in terms of cash value. So the beast was the 75-25, where we capitalized 40,000 for 4 years. From a cash value perspective, financing 3 trucks every 4 years, there was a clear winner at 788,000 of cash value at the end of that debt, or into that 30 years. The second runner-up is the caffeinated beast. So I guess with all of this, if I could leave you with one thing, the process works. Chris went through the whole money multiplier kind of overview at the beginning of our discussion. And you remember that engine that was sitting there with the supercharger on it? Looked like it had 2 carburetors. I don't know if those were Holley double pumpers or what they were. That engine's going to run really well. What we've spent time talking about today is, what kind of jets am I putting in that carburetor? What kind of cam do I have on that engine? How do I make that engine the most efficient and fastest thing I can possibly make for my purpose? So the guy that I've been talking with, Brandon, out at Altitude Junk Hauling in Denver, he has a different purpose for what he's trying to do than you might have for your business. So what it all comes down to is the Nelson Nash special the best policy for you? Is the beast the best policy for you? Is the caffeinated beast the best policy for you? The only way you're going to know that is if you get on a call with our money mentors and we go through this with you. All of our team knows how to do this. We design these policies. We look at how to put all this stuff together. So if you're on the other end of the line here listening to this, you're like, I don't know, what's the best thing for me? Just get a call scheduled. And Stephen, I don't know if you want to throw in the link and how people can do that. But this process works. And what we've gone over today is just finding the most optimal situation for this particular use case. And, I think that all 4 of these policy designs are awesome. They're way better than financing with someone else's system. But, this is kind of what we're looking at. So that's all I've got on this. I'm happy to go back, answer questions, drill in more, but Chris, do we have anything else to?
So now that you've learned how to take back control of your money and your business, how about you check out this video right here, which is all about flipping metal. Let me know what you think. We'll see you on the next one.